Good evening, everyone. Time is now 6:35 and we shall start. I can see a lot of people have joined in. Thank you very much. Once again, thank you very much for joining on this webinar. So today's special webinar is all about investing in India. So today the main three topics will be investing in India. What are the options? What are the options? What are the structures? Other than normal equity and property market, what are other options where people who are living in Australia, they can invest in India? Second thing is, because majority of the people who are attending this webinar are Australian tax residents. So if you invest in India, or let's say in any other country outside Australia, how that income or capital gain will be taxed in Australia. So it's very important to understand from the time you invest, or before even when you start thinking about investing in India or in any other country, you should be mindful about how that income or the gain will be taxable in Australia. So that is the another point that we are going to cover on this webinar. And third topic that we are going to discuss is doing business in India. So if you are already running a successful business in Australia, or if you have a good business idea which you are thinking to start, and you want to expand that business outside Australia, and you want to start taking advantage of Indian market, or if you have a product or service that you want to introduce in Indian market, how you can do that, what is the right structure, what are the tax consequences and compliance requirement in India. And once you start doing business in India, how that income you can bring into Australia and how that will be taxed again in Australia. Other side can be, if you have a family business which is running for many years in India, and if you want to grow that business outside India, and you are considering Australia as one of the markets, and you want to bring that business or the product in Australia, again, what are the consequences, what are the tax implications, what are the compliance requirements that you need to follow in both the countries. So these are the three main topics that we are going to discuss on this webinar today. And to present these three topics, we have, alongside myself, we have Shilpa Makadia, who is a partner, and herself is a chartered accountant and partner in S. Makadia and Company in India. Our other presenter on this webinar is Mr. Rajit Kothari, who is also a chartered accountant and certified financial planner, and who is Executive Director of Ashutosh Financial Services based in India. So I'll start first by myself. Hi everyone, myself is Vishal Patel. I am a CPA by profession, a registered tax agent and accountant, practicing accountant in Australia. I'm a director of Wealthcrest Accountants and Business Advisors. Our office is based in Bella Vista in Sydney. So we'll start with the first topic, navigating Australian tax rules in investing in India. So as I mentioned earlier, majority of the people who are or who have joined on this webinar are living in Australia. So technically we all are Australian resident for tax purpose. So what are the consequences if you start making investment outside Australian jurisdiction? Let's say we are focusing today only on Indian market. So what happens if you start investing in India? Either it can be in direct equities, you buy direct shares, you invest in managed funds or mutual funds, we can call them in India, or if you invest in rental properties or commercial properties, or sometimes now we have some sophisticated options like investing through gift city funds, right? So if you invest in any of those investment options, how your income, which is generated in India, or if you generate any capital gain, what are the consequences in India, how much tax you need to pay over there, and what are the tax consequences when you bring that income, or even without bringing that income, how much tax you are looking to pay in Australia. So first question arises, like when we left India, most of us, when I refer we, means all of us who are joined on this webinar, we came to Australia, our stories might be different. Some of us might have come 2 years ago, some might be living in Australia for 10 years, some maybe more than that, 20, 30 years. So why we need to invest in India, or why we should be thinking about investing in India? So there are so many reasons, but I've listed down primary reasons why anyone would be thinking to invest in India. So whenever you or we or whoever is thinking about investing, we are always thinking about achieving better returns. So first thing is India is one of the fastest growing economies in the world today with very strong capital market. Because in India, the population is so huge, that brings a lot of demand for basic needs and basic products and services. And because of the boom in IT industry and a lot of other tech boom, there are so many products and so many startups are happening in India. So as those companies grow in value, and it can deliver higher returns for their investors as well. So opportunities in shares, mutual funds, real estate. We have seen many cities. Traditionally, we were only talking about 4 or 5 cities when we used to talk about real estate market in India. But now there are even second tier or third tier cities, even rural areas are now booming in values. So real estate is one of the fastest growing, we can say, in the world. And as I mentioned earlier briefly about GIFT City. So GIFT is Gujarat International Financial Tech City, which is specifically designed. So it's not only geographically designed, but it is governance wise, and there are some set rules, different rules for foreign investors, which our other presenter in this webinar will talk more in detail about GIFT City investments. Other reasons can be increased interest from Australians. So when we talk about Indian Australians, we are now about 1 million in numbers, right? People who are born in India or people who are of Indian origin and living in Australia. That number is now close to 1 million people living in Australia. And a lot of Indians who are living in Australia, they always think about second income, investment income. So they are also considering self-managed super funds. They may not be happy with the traditional super funds and the returns that they are getting. So a lot of investors or a lot of individuals are now turning their direction towards self-managed super funds. So what are the options if you have an SMSF, or if you want to invest as an individual, where you can go in India, what kind of securities you can buy, can you even buy through an SMSF? So that's a burning question, and we will talk about that later in the presentation. And there are some like favorable demographics and regulatory changes. When we talk about ease of doing business in India, there is an index which is tracked by the Indian government and which is widely discussed in media, and we all might have seen ease of doing business in India index. India is consistently ranking better and better every year. So these are the main reason why anyone should be thinking of investing in India. So as we all are living in Australia, we all are tax residents in Australia. So one basic rule about that is when you are living in Australia, working or generating income in Australia, we pay tax on our Australian income. But that's not all. If you have any income which is generated outside Australia, means your worldwide income, that is taxable in Australia. A lot of people don't understand this and they don't care about when they are lodging their tax returns. But you must be, mindful about if you have any worldwide or overseas income, you need to declare that on your Australian tax returns. So the second question comes, if you have generated any income or capital gain in foreign country, let's say in India, then Indian government will want you to pay some tax over there. So again, when you bring that income here, or even if you don't bring that money here, you are still liable to pay tax on that income. So what happens to that income? Do you need to pay tax twice? We will see. Foreign income must be reported in Australia using your ATO exchange rates. So when we generate income in foreign country, obviously those countries have different currencies, and those countries may have different reporting regulations surrounding that. So when you have income which is not in AUD, let's say if you have lodged your tax return in India, you have declared all your Indian income over there, but those income may have generated at different time, right? And that income you have declared on Indian rupees. So how can you report that Indian rupees onto Australian dollars? You cannot simply take any rate. Australian Tax Office has given, or every year they issue exchange rates that you need to consider and convert your Indian income or any foreign income while reporting on Australian tax return. Eligibility of foreign income tax offset. So what is foreign income tax offset? As I said earlier, if you have generated any income or any capital gain in any foreign country, first right to tax that income is that particular country where you have generated that income. So if you have sold any property in India, if you have received any dividends or rental income in India, you may pay tax in India. So what happens when you report that income in Australia? Do you need to pay tax twice? No. There are some rules around that. And if you qualify under those rules, then you may get some offset of the amount that you have paid already in India. So we'll see a little bit in have some deeper understanding on what is the tax treatment of Indian income. So when you have income like investment income, like dividends, that is taxable in Australia, and you get credit for any withholding tax that you have already paid in India. Let's say if you generate any capital gains, so if you have sold any property, if you have sold any shares, then you need to convert that gain amount into AUD using the ATO rates that they give every year. And this is very interesting and very important to follow. Like any gain or any income that you bring or even report from overseas onto your Australian tax return, the rules under which it is taxed in Australia is Australian tax rules. So in India, you may not get long-term capital gain tax discount after 12 months. Rules may be different. I'm not an expert in Indian taxation, but rules may be different. But here, when you report that income onto Australian tax return, you have to follow Australian tax rules. So let's say one interesting example I would like to give you is if you have a rental property in India and if you have a negative gearing on that property, you get negative gearing tax benefit in Australia because that's as per Australian rules. Rental income. So when you have any rental income, whether it's a commercial rental or residential rental, you need to declare the gross rent that you are charging to your tenants. Then you can deduct all your expenses. In India, you may be claiming percentage of your rent as an expense. That method is not allowed here. You have to have actually incurred expenses. You need to identify those expenses and you can claim them. But again, if you have negative gearing on rental properties, you can claim negative gearing benefit in Australia. Most importantly, you need to keep all records, contracts, bank transfers, any tax returns that you lodge in India. You need to keep all the records. Even if you are not sure how that income will be reported, please keep your records and discuss with your accountant when you lodge your tax return here in Australia. So India and Australia, both countries are now cricket is not the only reason that we are connected because a lot of Indians are now living in Australia. Both these countries are now culturally connected and also connected through various other government agencies. So recently, India and Australia, I think in 2019, they have strengthened this double tax agreement even deeper. So now if you have income generated in any of these two countries, and if you're living in Australia, your worldwide income is reported here, but you don't have to pay tax twice. There may be some relief. You may get full tax exemption of the amount of tax that you have paid in India. So which allows offsetting Indian taxes against Australian tax liability. But again, one very important point to consider, if you are living here with your family, you have like PAYG income, you have business income. So your primary source of income is in Australia, then you may be already paying tax at 30, 40, 45%. So even a small percentage of your Indian income that you may report in Australia, that may go on the top tax bracket. But there are some ways you can mitigate that. We can discuss that later. Again, the other important thing you need to be mindful is the timing mismatch because India and Australia do not fall or do not follow the same financial year. In Australia, the financial year starts from July, ends in June. In India, the year starts in April, ends in March. So when you report this income from India into Australian tax return, you need to be mindful. You need to report exactly any income generated from July to June. And you need to understand which country has taxing rights. Again, taxing right is very deep topic to discuss. We may not be able to cover fully, but depending on the nature of your income, either the host country or the foreign country whichever country has the taxing rights. Sometimes you may earn some income in India, but Indian government may not have the taxing right on that income. So you need to check with your accountant in India if you're lodging tax return over there, or you can discuss with your Australian tax agent. Now, this is the burning topic. Can SMSF invest in India? In my career as an accountant in last 10 to 15 years, any SMSF investors who is of an Indian origin has asked me this question. Can I buy a property in India using my super fund? Can I buy shares in India using my super fund money? The simple answer is yes, because self-managed super funds are governed by CSEC. And there is one basic principle that you need to fulfill is sole purpose test. Again, these are not the only requirement. There is a huge list of requirements that you must follow. So always check with your accountant, check with your auditor before you make any decision. But simple answer, yes, your super fund can purchase shares, can purchase even property. Yes, there is no prohibition, but there are some compliance issues. So you need to be mindful. You need to be very, very sure what kind of security you are purchasing, what are the rules around that. And SMSF is Australia specific structure. So you need to be 100% sure that Indian government or the bank where you are opening a bank account or the security where you are buying in offshore country recognizes your structure as a retirement structure, and that investment is registered under the trustee of an SMSF. That is the very, very basic requirement. You must follow that. Again, foreign investment must align with SMSF strategy. SMSF strategy is a document which tells the trustee that where this SMSF can invest and where they can't invest. So you cannot go outside the scope of your SMSF strategy. If your existing strategy doesn't allow you, you can make changes in your strategy first and then make that investment. So always check with your accountant, check with your auditor before making any decision. Again, audit readiness and documents are crucial. As I said, I cannot give enough importance on the CSEC and the sole purpose test. You must understand the requirements first before you make any plans, but there are some options available now where you can get benefit of investing in regulated funds, in gift city funds directly through an SMSF. You don't even need to open a bank account. So Rajit will go into more detail onto that. Now you have made the investment. You start getting some income from there. Either it's a rental income, stock income, investment income. Now, what are the reporting and compliance requirement for that? So foreign income must be reported on Australian tax return. As I said earlier, there are two questions on Australian tax return. One is asking about whether you have any foreign investment income. Second question asking about, do you have any real estate outside Australia with value of more than $50,000? If you have not looked at those questions in the past, please, when you lodge your next tax return, please make sure you answer correctly. And you discuss if you have any income, if you have any assets in India or in any other country, please discuss with your accountant and do the right thing. You need to declare all Indian assets and income annually. So if you hold any asset, if you have any income, you must declare on Australian tax returns. Again, the rules are different. The timing of purchase of those assets, whether you purchase that asset before coming to Australia or you purchase that asset while being in Australia. So different purchase date, different rules. Make sure you comply with all the relevant tax authorities, AUSTRAC, and any other government authorities in India as well as in Australia to avoid putting your feet on the wrong leg. Now, what are the structuring considerations? We have so far discussed individuals, SMSF, but you may have a family trust. You may have a bucket company within a family trust, which is regularly getting money transferred from your family trust. Now it has a corpus ready for investment. Can you use that money? If you have a company set up only for the investment purpose, can you do that? Yes. The structure is very important because the structure will dictate how it will be taxed in Australia and how it will be recognized in India. So you can invest offshore, you can even invest in Australia using all these structures, and these structures are 100% correct for foreign investment as well. And as I said, impact on tax rates, because company is taxed either at 25% or 30%. Trust depends on the beneficiary. SMSFs are taxed primarily on 15%, 10% for long-term capital gain tax. So you need to understand, you need to check your existing income at personal level, existing income in those companies, trust and SMSF, and you can do a proper tax planning. Again, other aspects, asset protection and estate planning. These topics are very, very important, because now, we have second or third generation living in Australia of Indian origin people. So obviously, if you want to pass on some assets to your kids, if you want to do some estate planning, you need to consider these things before you actually set up those entities or you start making investments. This third topic, avoid nominee or informal arrangements. We have seen so many times, like, we have clients or someone from our community comes or calls us saying, hey, I invested certain amount of, my savings in India under my brother-in-law's name, under my family member's name. Now we don't have good relationships. So the investment is gone. So again, before you enter into any such arrangements, please talk to your accountant, please get some legal advice and document them. Don't just go under informal arrangements. So the last point I cannot emphasize enough, discuss your plan with your accountant or with any advisor. If you have a financial planner, if you have an accountant, make sure they understand what you need and make sure you discuss everything before you think of investing. So these are all the points in brief about how any investment, if you do in India, how that will be taxed and how that will be looked at in Australia. I would like to invite our next presenter, Rajit Kothari, who will talk about different investment options in India. And if you have any question during the presentation, please stay with us until the end of webinar, and we will open question answer session at the end. And we will also share our personal email addresses and phone numbers, so you can send your questions if we can't include everything at Q&A. Thank you very much.
A very good evening to all the participants who have joined from Australia. Moving further with today's presentation on the investment opportunities that are there in India, in line with the kind of options that were discussed by Mr. Vishal Patel for the super fund structure as well as in the individual capacity. Starting with the GIFT City, which is a very interesting development that has happened of late in India. And that is something which is very convenient for investing under the super fund structure, because the investment remains under the ownership of that trust. GIFT City is a global financial center that has come up in India recently. And the vision of the present government is to make it similar to any other global center, such as Dubai, Singapore, Hong Kong. It's an international financial services center, geographically situated in India. But from the exchange control viewpoint, it is a jurisdiction outside of India. And there are a lot of benefits that the government has provided to all the investors who are investing through funds that are set up in the GIFT City. To illustrate as to how can someone based in Australia take the benefit of this is the kind of diagram, and this is the way in which the entire flow of the investment would work. Wherein if there's any person who is of Indian origin like you, or even a person who is not of Indian origin, or any PTY Ltd company based out of Australia, or a trust, a super fund structure, any investor can participate into Indian stock market investment through the route of GIFT City. The way it would work is that this person, who could be any entity that I mentioned, would be investing into the funds that are set up in the GIFT City, called as Alternative Investment Fund, which is the technical name of those funds. And these funds would be then investing into the Indian stock market through the route of Indian mutual funds. So the underlying investment would be into the Indian stock market, but this is how the entire investment would be structured. The minimum ticket size right now to start is 150,000 US dollars. The advantage of going through the gift city route of investing is number one, is which was discussed by Mr. Vishal, that the investment can be done under the ownership and name of the very super fund trust. It need not be done in the name of only and only the individual. So that option is there. Other than that, the major striking advantage is that there is no tax implication in India. There is no question of any kind of taxation either at the fund level for whatever are the capital gains that are arising out of this, or even at the individual level to the investor or the trust or any entity that is investing, because it is a special benefit that has been given by the government to all the investments that are done through the GIFT City funds. Since there is no Indian income tax implications, there is also no requirement of filing a tax return or getting into any kind of tax assessments, or even quoting the taxpayer identification number of India, which is the PAN. Over and above this, there is also no requirement of opening any kind of bank account in India or a brokerage account, which is called as a demat account in India. So the funds can flow directly from the Australian bank account to the GIFT City fund and back. Of course, if there is a person of Indian origin who wants to utilize the funds lying in the NRE account, it would be treated as outside remittance, and the funds can be invested in the GIFT City fund through the NRE account. However, it is not a mandatory requirement to have a bank account in India or to even have a brokerage account in India, and the funds could flow directly. The investments are denominated in USD, and the rate of conversion that is also there with the GIFT City funds is quite competitive as compared to what can happen at the individual level because of the volumes of the forex that they are dealing in. The onboarding process is also very simplified. We've onboarded several investors across the globe through the GIFT City fund, and the entire ecosystem has reached a level today where there are a lot of different mutual fund companies in India who have started their GIFT City funds, and these are all feeder funds, meaning they simply pool the money and invest into the very same mutual funds that all of us have been investing since decades. And the onboarding is quite simplified in the sense there's no requirement of physically visiting India. It can all happen sitting at your home. Only a few documents are required. To summarize the entire process that I mentioned, the way it would work is that the investment has to be done into the GIFT City fund directly from Australia. And these GIFT City funds called as AIFs would be investing into the Indian mutual funds, the very existing old mutual funds which manage not thousands but lakhs of crores of rupees, which invest into the Indian equity stock market. And then whatever is the gain that would arise eventually from the appreciation of these investments would be completely tax-free in India to the fund as well as to the investor, and then the entire proceeds can be repatriated back to Australia. The advantages which we discussed are: number one, it's USD denominated, basic KYC requirement, no requirement of entering into any formalities, compliances of opening a bank account or a brokerage account in India, and most importantly, no tax implication for any kind of capital appreciation that might occur from these investments into the lucrative Indian stock market, which all of us, not just persons of Indian origin, but everyone practically these days wants to take exposure considering the kind of robust growth that the Indian economy is witnessing. Moving further with the other routes of investing, especially when someone wants to invest their personal funds, which are not super fund investments, is through Indian equity mutual funds. Equity mutual funds help in participating in the Indian stock market through a structured manner. And these days, it is the most popular means of investing in the Indian stock market, and it's convenient at the same time. An ideal mutual fund portfolio that someone should look at should be designed considering in mind all three parameters that we have mentioned, which is the financial profile of the investor as to what are the kinds of incomes, assets, liabilities, expenses that the kind of investor is having, and should be suited to the financial appetite of that person. The kind of risk that the investor is willing to take in terms of the volatility or the fluctuation in the valuation with the passage of time is also very important. And ultimately, for what purpose is the investment being made is also very important, so that the investment is in line with the kind of expectation that an investor has. Systematic investment plan is a very effective means of investing in India these days, and the entire India has started accepting these means of investing. A lot of investors from Australia also are investing through systematic investment plans, wherein an investment is done in mutual funds on an ongoing basis by every month. There are a lot of different categories of mutual funds which we have enlightened in this slide, and appropriate diversification and the bifurcation across all these categories is very important, because every category has got an important role to play in the growth of the entire portfolio. And the best part about mutual funds is that it can be started with any amount. We can start with even a few thousand Australian dollars, so that an investor has got a confidence and can test the waters of the Indian equity markets, and with passage of time can increase the exposure. This is the structured manner in which we proceed towards mutual fund investment onboarding, wherein we prepare the asset allocation, which has a bifurcation across different categories of mutual funds, which is large and mid, flexi, multi, and each category has got a different definition and style of investing, basis the parameters that I mentioned in the earlier slide, which is the financial profile, risk appetite, and financial goals of the investor. Thereafter, we go towards the scheme selection process, in which we have prepared an extensive key performance indicator matrix, which is used as the benchmark for selecting those schemes, and has got a complete analysis from all different standpoints on which is the comparison with the benchmark, quartile evaluation, past performance, allocation across categories, which is a very scientific and logical approach towards selecting the particular scheme within that category which we go for, which is, let's say, large cap or mid cap or small cap in this case. Once the mutual fund investment is done, a review of the entire investment on an ongoing basis is very important, so that the portfolio remains in tune with the changing market developments, and whatever are the newer opportunities that might be there are taken into consideration in the financial portfolio. So this is how we conduct a thorough review of the portfolio, wherein if there is any investment which is into mutual funds and into a scheme which is not performing, then we suggest moving to a different scheme if we see better opportunities in the other one. Similarly, allocation across different asset management companies is also very important, so that the portfolio is not lopsided towards a few ones, and is also not too scattered across a lot of investments. The second avenue of participating in the Indian equity market is portfolio management services, in which the concept is the same, that there is investment into equity shares, and the entire investment is managed by a fund manager and his expertise of his team. The difference is that there is a separate brokerage or a demat account that is opened for that investor, and the shares are held in the ownership of that particular investor. Now, the way it is different from a mutual fund is that, number one, it is a concentrated portfolio. While a mutual fund comprises of 60 to 70 stocks on an average in its own portfolio, PMS has got 20 to 40 stocks in its own portfolio. So since the number of stocks are lesser, the chances of the investor gaining appreciation over a longer term are also greater. The kind of regulatory restrictions which are there in case of a PMS are lesser in terms of the sector specific cap, stock specific cap, whereas in case of a mutual fund are greater. For example, a mutual fund cannot own more than 10% in a particular stock. So this gives a free hand to a portfolio manager, a PMS fund manager, to take greater calls with flexibility as per the kind of opportunities that the person is seeing. And the third difference is that if there is an inflow or outflow from any other investor, in case of a mutual fund, it impacts the entire pool because it's a pool of money, where in case of a PMS, since it's a separate brokerage account, a demat account for that investor, the inflow and outflow of other investors does not impact that investor. And the minimum ticket size as of now is 50 lakhs of rupees for a PMS in India. And that 50 lakhs can be bifurcated into different schemes, the way we can do in case of a mutual fund, such as a small cap, mid cap, depending upon the financial profile of the investor. Retirement planning is also one of the very popular avenues which so many people living in Australia are looking for, considering the kind of retirement that they would be witnessing in the next 1 to 2 decades. Retirement planning in India can be done through both the avenues. The first avenue is through the equity-oriented investments, which I already discussed, in which there is a systematic investment and a corpus is built, and that withdrawal can happen through systematic withdrawal plan, which is exactly reverse of a systematic investment plan, in which there is a lot of tax efficiency in India. for the systematic withdrawal plan in case of mutual funds. Second, the balance corpus, which we are not withdrawing, can keep growing with the growth of the economy and the stock market. The third benefit of the systematic withdrawal plan is that there is flexibility of increasing the amount or reducing the amount with the time, depending upon the requirement of the investor. And the second avenue of going for retirement planning is through fixed income avenues, wherein there are guaranteed income plans. And this guaranteed income plans assure fixed return for very long tenures, as long as 30 to 40 years. So whatever is the state of the stock market, the economy, the interest rates, even if the central bank keeps reducing the interest rates, any person who is investing in these guaranteed income plans is assured of a certain level of income, which is also tax-free in India if certain criteria are met for very long tenures, as long as 30 to 40 years, as I mentioned, and the rates of return are also very attractive. And it can be designed as per the financial planning needs in the terms of the timeline of the investor. This is an actual case scenario, and we are working in this manner with not just few but a lot of families based out of entire Australia, wherein we act as a family office for them in India, and it's a one-stop solution for anything and everything that they can think as far as Indian financial affairs are concerned, right from managing their SMSF portfolio in India and earmarking that so that the trail is mentioned for the audit as well as the accounting perspective, which is a requirement of the ATO. And of course, the second is the Indian investments in the personal capacity, in the Indian mutual funds as well as PMSs, which have delivered a phenomenal kind of a return in the last few years, considering the kind of stock market growth that we have witnessed and also going to witness in the coming years. Third is, of course, the banking related coordination in terms of any kind of repatriation related issues or any kind of other operational issues that might be there for that particular family. Even Indian income tax compliance is something that we are into. So end-to-end Indian income tax compliances, including advisory, tax return filings, or any kind of tax assessments, is something that we assist. We also provide relevant data for reporting in Australia as per the Australian tax year running from July to June, converted into AUD for all the transactions that might have transpired during this period. So it becomes a plug and play kind of a mode to report the entire Australian Indian incomes in Australia, as rightly mentioned by Mr. Vishal, that global incomes, including the Indian incomes, need to be reported in Australia. So it helps with that as well. And of course, last but not the least, as we move towards the succession phase, estate planning in India is also very important. We help in preparation of wills in India for the assets that are situated in India. It is recommended to have a separate will in India for the Indian assets and also private trust wherever is a need to do so. We have been conducting a lot of financial awareness events, and last year we had got physical events across practically all the locations in Australia. And we continue our mission to financially empower the entire Indian diaspora of ours in Australia through a series of digital as well as physical engagements in the future as well. Thank you so much. Now we move forward to the subsequent part, which will be taken by CA Shilpa Makadia.
Good evening, everyone, and good afternoon to those who have joined from India. So basically, this is a separate topic from what Vishal and Rajit has mentioned. So this is regarding setting up your business in India. So this is regarding foreign direct investment in India. So your first question would be how easy is to get into India, right? So Vishal has rightly mentioned that now India is on the top list of ease of doing business. At least it is easier to invest in India than getting your spot in Sydney CBD areas for the parking, right? So now let's move on to next slide. It's regarding investment options for foreigners. So these are the investment options for foreigner. Few of the options I think Rajit has already taken care of, and few of the options are regarding like how to invest in your business. First is the investment in unlisted or listed companies. except through stock exchange. Stock exchange, I think Rajit has already taken care of. And second one is investment in listed companies through stock exchange. Third one is ADRs and GDRs. And then there is a option for investment by non-resident Indians and PIOs and OCIs, like person of Indian origins and overseas who are having OCI card holders. Then there are investment vehicles which are this real estate investment funds, and EIF is also there. So alternate investment funds. So right now I would be talking about this foreign direct investment. So whenever it comes to regarding investing in India, first you need to check about your the type of business you are doing, you are going to do in India, the kind of business you are going to do in India, whether it is allowed or not. If it is allowed, under which route it is allowed. So first is a FDI allowed under automatic route. So in this route, you don't need to take any approval from any government. Second route is under government approval route, wherein you need to apply for the approval for the government, Indian government. And third is a route wherein up to few of the percentage it is allowed under automatic route and few of the percentage under approval route. So say for an example, if I'm talking about a pharma company. So if any person want to invest in pharma business, so if it is a greenfield project, then 100% it is under automatic route. No approval is required, right? And if we are talking about a brownfield, like if you want to do if you want to invest in already existing pharma company, then up to 74% FDI is allowed under automatic route. So if you want to invest more than 74%, then you need to go for a approval route. So this is the type of approval route, automatic route, and one is a mix of approval and automatic route. Then these are the prohibited sectors. So if you want to do business in all these types of business, then it is prohibited to do business. Even with the government approval also, you cannot do these businesses. Like lottery business, gaming is there. So if we are talking about real estate business has a definition. So if you are talking about real estate business in construction of farmhouses, if you want to invest in that kind of business, it is not allowed. But if we are talking about town planning or something like that, then it is allowed. So there is a like detailed definition of real estate. So first we need to check that definition before investing in any real estate, because many a times it happens that being a person of Indian origin, we are investing in real estate. So this farmhouses investment is strictly prohibited in India, because many of the foreign nationals, they are investing in it. And then there is a Nidhi company or cheat funds or manufacturing of cigarettes are there. Now, once you are decided that the type of business you would be doing in India is allowed, then these are the options which are available to you. So first is a JV company, right? So recently you must have heard about the news of Australian Blue Scope company has a JV with Tata Steel. And then there is another hydrogen powered JV is there, which is into H2X Global, and Advik High Tech is there. So these are the JVs which are there with the Indian and Australian companies. So JV is a thing wherein one Indian company would be there and one Australian investor would be there. So then another one is a wholly owned subsidiary company. You can have your wholly owned subsidiary in India. Wholly owned subsidiary, you don't need to have any joint venture with any company. Your parent company in Australia can have your wholly owned subsidiary, it is fully 100% held by the Australian parent company. Then for the if the businesses want to taste the waters of India, and before incorporating even JV or WS, if they want to taste the waters, then they have the unincorporated entity option, which is liaison office, branch office, and project office. So project office is generally for particular project, like if you got any project from the government or any other institution, then you can have your project office. That project office would be particularly for that particular project only. Then there is a liaison office option, which is generally it is availed by the companies who are into after sale services. They are selling from the overseas company, and then the like after sale services, then installation services, are those kind of services are taken care by liaison office. But in liaison office, you cannot do any business. It is kind of a just a extended office of your foreign company only. Then there is a branch office option wherein you can do trading but not the manufacturing. So these unincorporated entities are having their own limitations and restrictions. Okay, and in incorporated entity, you have a full-fledged, there is no restriction. Like in your JV or in your WS, you can do full-fledged business in India. There is no restriction because it would be considered at par with the resident company only. Once you register your company in India, it would be considered as a resident Indian company only. And all the regulations which are applicable to Indian company would be applicable to your company, your subsidiary company or your JV company. Then setting up business in India, we can have a as we mentioned that there are the options. So if you are going to have, because most of the companies, they would be having their either company or LLP, right? So there are before registering the company, you need to understand like what are the documents which are required. So whenever you are registering a company in India, whatever your Australian documentation are there, those needs to be apostilled from the Indian embassy over there in Australia, right? So these are the steps for incorporating a company in India. First, we decide the structure, whether we want to go for private limited company, listed company, or any like LLP. Even partnership is also an option, but there are restrictions for the partnership firm. Then second step would be to have the reserved our company's name. Then, as I mentioned, that document apostillization would be there. Then you get your digital signature certification, and then incorporation application would be done with the director identification number. So these are the like basic steps which I've mentioned. We can always have a detailed discussion whenever you are having any need. Then there would be post setup compliances. So these are the, once you register your company, maintaining a registered office is a must thing. You need to have your registered office in India. Then there would be first board meeting wherein you would be deciding your auditors and all. Then later heads would be required. Bank account opening would be there. Then share certificates you need to issue. And that would be a state stamp duty as well for issuing of share certificate. Then GST and IEC registration. GST is a goods and service tax, and IEC is an import export code. So if you want to just register a trading company, then IEC and GST is what you need. Then PRC is a professional tax registration number, which you would be needing for your establishment and as well as your employees as well. Then if you are going into manufacturing, then there would be Factory Act requirement and licensing would be there. Then PF and ESIs is the social security thing, which would be there for the employees' retirement benefits. So now coming to the like bringing in fund to India, there would be compliances from the RBI perspective. So RBI is a Reserve Bank of India, which is a regulatory body which is regulating the FEMA compliances. FEMA is a Foreign Exchange Management Act. So apart from all the Indian companies which would be following all the acts, but this would be the additional act which any foreign company which is setting up business in India need to follow. So under FEMA, if you are bringing in fund as a FDI, which is called foreign direct investment. So there are two kinds of things which we would be like with the foreign company would be bringing. Which one is in the form of a capital, another one is in the form of a loan. So in the form of a capital, it is called FDI, foreign direct investment, and in the form of a loan, if you are bringing, it is called external commercial borrowing, ECB. So once you bring your fund, you need to allot the shares. If you are bringing in as a FDI, within 60 days of receipt of fund, you need to report this to RBI. Then there would be paying of consolidated stamp duty. Then there would be FCGPR, which is a kind of a return or report which needs to be filed to the RBI. Now, these are the ongoing compliances, like ongoing year-on-year compliances, which needs to be followed. Like I think this would be there for the Australian side as well. Like few of the audits would be there, like statutory audit, GST audit, then tax audit would be there. So these are not the compulsory audits. Statutory audit is a compulsory thing, whether you are doing business or whether you are not doing business. But for the tax audit and GST audit, there is a turnover criteria. If your company would be crossing particular turnover, then only it would be applicable. Then there are GST returns, which are monthly, quarterly, or half yearly returns, which needs to be filed. Then TDS is a withholding taxes, which you would be withholding from the salaries of the employee, from the payments of the expenses you are doing. Then there is foreign liability and asset statement, which would be filed by your company in India, which is filed to RBI. Then a few of the ROC compliance like EOC for MGT7, just like you are filing an annual return in your host country, same way there is a annual return compliances are there from the company law perspective. Then the professional tax, which we have discussed, once you have taken the registration, you need to comply with professional tax returns as well. Then there is provident fund, ESIC, those are the employee based returns which needs to be filed on monthly basis. Payments needs to be done on monthly basis. Then because your company is a overseas company, there are country to country by country reporting as well. In India, it is not a Indian like requirement, it is a kind of a OECD requirement. So based on the OECD requirement, you can file it in your host country, or you can file it in India as well. So there are few of the transfer pricing also needs to be done, like 3CB form is there. So transfer pricing is a thing wherein you are having, because your parent company and your subsidiary would be associated enterprise. We call it AE. So once AE taste is established, you need to follow the transfer pricing regulations as well. Hope I'm not going very fast, but due to time restrictions. So taxability in India, just like Vishal has mentioned, that there are DTA, DTAA agreements with the Australian government. So you would not be paying any additional taxes. It would be not the double taxation. It would be just you can get the setup of whatever taxes you have paid in your host country for the same income. So for your company in India, you would be paying direct tax, which is in the form of a corporation tax. And there is indirect taxes, which are custom duty and GST. But like right now, there is a hot topic which is going in with India and US tariff and all. But rest assured that India and Australia is having a favorable tariff rates. So we don't have to worry about that thing. Then there are levies on transactions, like stamp duty is there, then security transaction, commodity transaction tax is there. So these are just for your understanding what are the taxes you would be paying in India. But all these are not applicable upfront, like it is transaction based only. So these are the rate of taxation, direct taxation, corporation tax, which would be applicable to your company based on the turnover criteria, based on the in which, like if it is a manufacturing company, it is a trading company, based on those kind of criteria as well. So it ranges from 15% to 25%. Okay. This is just for your understanding, like how GST, which is an indirect tax, like goods and service tax, what would be the range? It ranges from 0% to 28%. When it comes to essential items, it is 0%. For basic necessity items, like day-to-day necessity item, it is 5%. And for the luxury goods like Apple, iPhone and all, it is 28%. So this is the GST supply chain model. So we can we can discuss in person whenever you have a need for the same. So, like, why to invest in India? You must be thinking about like what are the benefits. So, first benefit is regarding cost effectiveness in the when whatever we are talking about manufacturing or trading. So, cost effectiveness is there, and then there are government PLI schemes. Like government PLI schemes are there for the API manufacturing. Then there are government schemes if you want to have a kind of GCC unit in India. So there are very tempting schemes of government benefit are there, wherein even for few of the GCC companies, if they are investing more than 80% of of their investment is like returned back by government in the form of subsidies. So these are few of our clients to whom we are serving. This is just to name a few. Like you must have heard about the MG car in India. So one of the supplier to MG car, which is inside the MG cars manufacturing unit, is LZWL. We are serving to this client. This is the first SBRT company, single brand retail company, which is having now, they are having more than 70 stores in India. Then this is a steel manufacturing company. They are into Fortune 500 company list of world. They are into kind of like logistic company, and so that's all from my side. Vishal and Rajit, we can have a Q&A session now.
Yes, sure. Thank you very much. Thanks, Shilpa. And thank you, Rajit. Hope you all can see my screen now. So as we have discussed various topics during this 1 hour, so again, it's not possible to cover everything in detail in such a short time span, but we have tried our best to take most of the topics that we can take. So now we are opening Q&A session. So if you have any questions for myself, for Shilpa, or for Rajit, please send your questions in chat box. And if you have a detailed question or if you have something which you don't want to ask right now, please feel free to contact our office in Australia or in India, or you can write an email on the email address which is mentioned on the screen right now. So yeah, we are opening up a Q&A session. So feel free to send your questions right now.
Yeah, I've received a few questions. I'll take them one by one.
Yes.
The first question is from Mr. Kedar, who is asking, do you have to be a foreign citizen to invest in the GIFT City funds, or a permanent citizen of Australia, and can Indian citizen invest in it? The citizenship does not matter at all. The only requirement is that the person has to be a non-resident under the Indian Income Tax Act, for which if the person is resident, is living outside of India predominantly for pretty much major part of the year, then the person is qualifying to be a non-resident, irrespective of the citizenship, whether it is Indian or Australian or any other citizenship. A person can invest in the GIFT City fund. The only thing is that the person should be living outside of India predominantly, which I assume that you, since you are based out of Australia, you will be living. So that it answers the first question. The second is, I assume there will be some tax implication for the GIFT City investment in Australia. Could you please advise? I would request Mr. Vishal to throw some light on that.
Sure. So yes, as Rajit has mentioned, you can get some special benefits of investing in GIFT City by paying zero tax on Indian income in India, but any income that you generate in India, that has to be reported on your Australian tax return. And again, it depends under which structure have you invested. So if you have invested under your personal name, that income will be reported on your personal tax return. If you have invested via a trust or a company, then that will go as company or trust income, and whoever is the beneficiary or the ultimate shareholder of the company, we can have some tax planning, and it's not a straight answer to that, but yes, whichever entity holds that investment in India in GIFT City, that is liable to pay tax in Australia. So if you have, for example, invested via an SMSF, then yes, your SMSF will report that income on the income tax return and it will be liable to pay tax.
Perfect. I think there is another question from Mr. Himanshu for GIFT City funds again. Are they for real estate as well or only stocks? Uh, there are certain funds based out of GIFT City which invest into real estate projects. But one thing which we need to be mindful is that the income tax benefits which are there in the alternative investment fund structure in India are predominantly for the financial assets, wherein if the GIFT City fund is investing into mutual funds or into derivatives. So the major GIFT City funds are having an underlying exposure into the Indian stock market through the route of mutual funds. So that is because that is the entire advantage of going through the GIFT City route. However, if someone wants to take exposure into real estate, then there is no requirement of going through GIFT City by and large, because there's no tax benefit firstly, and there are a lot of other funds in the mainland India in the structure of a AIF which invest into a lot of good quality real estate projects. I think the next question is from Mr. Vikram Limaye that how soon are we expecting retail funds with a small ticket size? Uh, There has been a lot of discussion going on about it since quite some time now, but there is no affirmative response from IFSCA, which is the authority governing the GIFT City ecosystem for the retail funds. So that is something which we are not aware, or we may not be the right persons to answer on. But yes, there are talks about retail funds going in and the ticket size reducing. But the time is something which I think we'll have to wait and see. The other question is that if a person invests into PMS through the GIFT City route, is he or she required to pay tax in Australia according to SMSF taxation laws? I think Mr. Vishal already answered that. So if there's anything else that you would like to add, then we can do that. Otherwise, we can move
Yes,
on.
sure. So yes, so any investment income which is generated under SMSF structure is likely to pay tax at 15% tax rate in Australia. So if it is exempt from paying tax, if you have invested in such a structure that you don't have to pay any tax in India, it's I would say it's a golden opportunity. You have direct exposure, direct access to the Indian market by only paying 15% Australian tax rate.
Right. Then the next question is from Mr. Bhavesh that what is the procedure of buying properties in India as an Australian citizen, and what are the requirements about it? So any OCI card holder who is an Australian citizen can invest in real estate in India. They cannot engage in real estate business, meaning buying and selling of lands on a frequent basis, but they can invest in any real estate property, which could be a residential or commercial property. And the process is that the funds can be invested through the NRE or the NRO bank account irrespective, but the funds would go back to the NRO account when the property is sold. So it would be pretty much the same as what any person like us who is living in India is going about, wherein the funding can happen through either of the two, to NRE or NRO account. And then whatever is the requirement as per the local laws of that state for the property registration have to be fulfilled like any other property buyer who is also based out of India. Yeah, moving with the next question, can we invest in shares in India from SMSF? And what is the tax slab for every rupee gain in stocks for a non-resident or a OCA card holder? I believe we can invest in stocks from SMSF fund. Is that right, Mr. Vishal?
Yes, yes, yeah. So as you mentioned, like there is a direct access through GIFT City funds. So yes, it's the best option available. And again, so you can get access of Indian equity market, Indian stock market, Indian mutual funds, while investing directly from your super funds. But again, yeah, whatever are the requirements, the ticket size and all that has to be followed. But yes, it is quite possible.
Right. And the rate of tax for the long-term capital gains in India is 12.5% beyond the holding period of 1 year, with an annual exemption limit of 1.25 lakhs of rupees. and the short-term capital gains on stocks is 20%, which is a flat rate. The other question is, how do we invest in mutual funds in India through NR or NRE account? The route is pretty simple. Through the mutual funds, the investment can be done through either of the two bank accounts. We can guide you with the entire operational process of it and build and design a portfolio customized to your individual financial needs, and then that can be monitored and reviewed on an ongoing basis. And that is the a lot of people across the world, not just from Australia, are seamlessly investing in India these days. Okay. Then the other one, I think we'll take two more questions because we are having some time constraints thereafter.
Yes, yes. Yeah, we can take two more questions, and then for any other questions which we can't take, uh, rest assured that we will respond to you on your email. If you can just send your email address with your questions, or if you have a detailed question which may require personal attention, please feel free to send us, your questions on email, or you can contact us directly on our office numbers.
Okay, so the one of the question is, do you help with portfolio selecting in ETF stocks for SMSF in international market within Australia? So our domain is with respect to the Indian markets, and we are also working in the US market. So because we see a lot of opportunity in these two markets per se, and we are not into advisory for the Australian stock market related investments. We'll take up the
One of the question from Ajay Nair is that I recently got mail from ICICI Bank that when I sell my mutual funds, they'll hold 20% TDS of full value. So because it is requirement of India that they need to deduct this 20% TDS. So whenever your any withholding taxes are deducted, you need to file your tax return in India and get it back, or you can get the tax credit in Australia, but it would be there. This 20% TDS would be there.
Yes, Rajit, we can take one more last question.
Sure. Someone has asked for your email address. I think the email address is very much in front of us. Which is Vishal at wealthcrest.com.au. And the final question is, if an NRI sells the property, uh, what are we going to have different tax slab within regards to capital gains? If an NRI sells the ancestral property, will there be tax slab like Indian or NRI? So if an NRI,
I think I can answer that question.
sure, please.
So regarding like NRI selling the property in India, so generally what mistake is done by all the buyers and sellers is they would be deducting just 1% TDS. But here this one section 194 IA which tells about 1% TDS is not applicable, and because it's a non-resident who is selling the property, another section would be applicable, and wherein whole sale consideration, the TDS amount would be there and not on the capital gain tax. Okay, so whenever you want to deduct your TDS on your capital gain, then you need to apply for the lower deduction certificate to the income tax department. So it is a time consuming process. So whenever you are selling property, have a buffer time as well, because it takes around 15 days to 1 month to get this certificate.
Yes, and I would
I
like
think,
to.
yeah, someone has asked for what are professional charges. So we'll just answer that and then conclude. So the professional charges, the way it works is that we do not charge anything separately from the investments. There is an expense ratio which is charged by the asset management company, which takes care of all the regulatory fees in terms of the advisory and everything around that. So there is no separate charge which is levied to the investor, so there is no extra cost that they need to bear.
Right. Thank you very much. Thank you, Rajit Bhai, and thank you, Shilpa, for joining and giving us your expert inputs on uh, Indians who are living in Australia and how they can invest, their wealth, or they can create wealth by investing in India. So once again, thank you very much, everyone who has joined through the webinar. And we have a plan to have another follow-up webinar, which can be, we can take questions, more questions on what we have missed on this webinar. Plus, we are going to deeper into these topics. And later this year, we are also planning one in-person event across Australia. So not only in Sydney, but we are trying to do in-person events in multiple cities in Australia. And the schedule for that will be shared with everyone who has joined today, and it will be shared on our social media platforms as well. Thank you very much. And we are going to close this webinar very soon. But once again, thank you very much, everyone. Thank you very much,
Thank you.
speakers, for your valuable time.
Thank you, everyone. And as mentioned by Mr. Vishal, and I think someone has also asked, we'll be sharing the presentation PDF as well as the video recording of today's session with all the participants from the contact details that you have used for registration. Thank you.
Thank you.